Welcome, everyone, and thank you for joining us today. I'm Brandon Kuntz. I'm a partner here at Research Affiliates, and I'm a multi-asset strategist. Joining me today is Cam Harvey. He's a board member, a senior advisor, and coordinator of firm-wide research activities here at Research Affiliates. And many of you are already familiar with Cam, but it's probably worth noting that he's also a professor of finance at Duke University. He's a research associate at the NBER, and he's a past president of the American Finance Association. For those of you that don't know, he's also published over 125 different scholarly articles, and he's received the Bernstein Febosi Jacobs Levy Award for Best Article in both 2015 and 2016, and he's already received 8 Graham and Dodd Awards. If you don't already, I'd suggest following him via LinkedIn, where he provides a bunch of regular commentary. Now today, Cam will be reviewing with us a couple of our more recent research insights. In particular, he'll be discussing some information around the incorporation of intangibles into measurements of value, and he will also be talking about a novel approach to the generation of appropriate frameworks for relative value pairs trading. After he presents on each of these topics, I'll then ask him a few questions that come to mind to get a discussion going at a broader sense. At the end, I'll ask him some more general questions. Some of these questions will be questions that you as an audience have submitted beforehand that are pertaining to really kind of more generally how research is done here at Research Affiliates. Before we jump into the conversation, though, let me just check the box on a couple of different housekeeping items. Many of you have already submitted questions. But if you want, you can also submit more questions at the Q&A widget, which will be on your screen. Also, you'll notice on your screen, there's also going to be some articles that Cam will be discussing. You can click on links to those articles to actually read those papers themselves in their entirety. And you'll also notice a couple of links to some tools that we provide, and many of you are aware of these, but these are some of our interactive tools that provide forecasts for both asset classes and equity strategies and factors. And we update those tools on a monthly cadence on the asset allocation front, and then on a quarterly cadence for the equity side of things. So for those of you that are interested, click on those, feel free to explore, and certainly feel free to reach out to me or Cam if you want a deeper dive on anything that we're doing within those interactive tools. With that as backdrop, let's move straight to our first topic.
Hi, I'm Campbell Harvey, and I'd like to talk about some research that I've been conducting with Rob, Vitali, and Juhani. And it has to do with intangibles. We call it the trouble with intangibles. It is based upon a larger research program on value investing, and that paper is available for download on SSRN. So the plan is pretty simple. We want to talk about how to measure intrinsic value. We'll talk about the evolving US economy, and given the structural differences between the economy today and the economy of the past, why it's necessary to include intangible capital in a measure of book value. We will explore what intangibles actually are and make the case that they should be included in a measure of intrinsic value. And finally, we'll actually introduce a new measure of value. And we call it IHML, and the I stands for intangibles. So let's start with the basics. And the basics happen to be value investing. And the idea of value investing, as you know, is that you identify stocks that are cheap and they're attractive to buy, and stocks that are expensive, and those are stocks you avoid or sell. The problem is, how do we identify cheap and expensive? So what people have traditionally done is come up with some metric, and book value is an example. So, for example, let's look at the ratio of the market value of a stock to its book value. And suppose that's a very low number. So suppose the book value is even greater than the market value. That would be a stock that a value investor would consider potentially attractive. And if we had a market value to book value that was really high, so the market value is multiples of the book value, well, that's a stock that would be considered expensive and avoided or sold. Okay, so that's the basic, and the key is to have a measure of intrinsic value. And the question is book value that measure? Now, value investing was operationalized by Fama and French in 1992 when they introduced their factor HML, and that was based upon book value. However, the idea that book value somehow represents intrinsic value is problematic. And actually, the idea is not a new idea. It goes all the way back to the famous Graham and Dodd 1934 security analysis. Okay, so I recommend you actually read this book. There are gems in this book that are only being discovered today. So for example, they're very clear on book value. So they argued that book value is problematic in terms of representing intrinsic value. Indeed, the language is quite strong, saying that it proved almost worthless. Yet that's what many people do today. They use book value. And again, the standard HML factor is based upon book value. So the world has changed, and it is even more important today to take book value into account. So maybe a measure of tangible capital was adequate in kind of the post-war era through the 1970s. And Fama and French, indeed, using data through the 1980s, could get away with using book value. But our economy is much different today. Intangibles are much more important. So we are now in a more service and technology-oriented economy. So it's more important today to actually incorporate these measures of intangibles. So what does intangible capital actually look like? And this is a schematic from another paper that I'm a co-author on. And it details what tangible capital is versus intangible capital. And we kind of know what tangible capital is already: property, plant, equipment, accounts receivable, inventory, things like that. But what about the intangible assets? Well, things like intellectual property, R&D, patents. You've got legal rights, brand value, trade secrets, goodwill, the money that you've spent building client relationships. That's all valuable capital, and it's all intangible, and it is all ignored in the traditional book value calculation. So let's actually explore one part of intangible capital, and that is research and development. So let's think of the logic. So why would a company invest in R&D? Well, it's clear that they believe that the benefit of the R&D investment greatly exceeds the cost. So it's an investment. It's a longer-term investment, and you only make that investment if you believe the value is positive. That should be incorporated into intrinsic value, but it isn't. And indeed, it's even worse than I said, because the R&D expenses are deducted from book value. So we should be adding the capitalized value of the R&D, but what we're doing is subtracting. And this leads to a severe misclassification. So I said that this was more important today than it was in the past, that Fama and French could get away with using book value with the data through the 1980s. And this graph kind of shows that, well, yeah, that's true. And it also shows that today is a lot different. So look at that blue line. The blue line is the average firm in the US. And it shows that intangible capital is about the same size as tangible capital. So how can you ignore 50% of the capital? That will get you into trouble. And even for value stocks, intangible capital is about a third of capital. Now, obviously, for growth stocks, intangible capital is very, very important. Okay, so why not take this into account and reformulate a measure of book value that takes capitalized intangibles into account? And that's exactly what we do. And this is what it looks like. So the blue shows the traditional metric, HML. The orange is our new IHML that takes intangibles into account. And notice a number of things here. So number one, the IHML does much better than the traditional metric. And the graph just above the curves shows that outperformance is especially important in the most recent data, which is again consistent with our economic intuition. And what's going on here? So why is this the case? Well, I think the solution is kind of self-evident. The traditional measure of book value leads to a misclassification. So the traditional measure of book value as a value metric might classify a stock as a growth stock when it's really a value stock. And it might classify a value stock as a growth stock. You get it backwards. You're misclassifying and adding noise to the actual signal. So this is really important, this misclassification. This graph shows significant differences between the two strategies. There's one final thing from the graph that's important. Notice that value is in a drawdown. And it's been in a drawdown for quite a while. It turns out that incorporating intangibles doesn't solve that problem. It certainly mitigates the size of the drawdown, so the drawdown is less when you incorporate intangibles, and the length of the drawdown is substantially less, but the drawdown still exists. So indeed, that is the topic of further research that I've been doing with Rob, Vitali, and Juhani. So let me sum up. So the first thing is that the world's changed. And this is an obvious misclassification, and we need to do a much better job of developing measures of intrinsic value for value investing. And we're doing something that, again, is not revolutionary. It is something that reflects the times. It reflects the structural changes in our economy. And when we actually implement that, it leads to a superior performance of this particular value metric. But again, let me emphasize, while this provides much better performance than the traditional measure, it does not account for the size of the drawdown that we're experiencing right now. And if you want a further examination of all of the determinants of this particular drawdown, that is part of the larger research program that I encourage you to take a look at.
All right, Cam. So now I'm going to kind of dive into some of the details here with some questions. And I know you already alluded to this, but can you give us a preview of what the next steps are for this research? I guess, I'm curious, are you just looking to further refine our definition of the IHML factor, or are there other unique measures of intrinsic value that you think can be complementary to our IHML approach?
Sure. So think about what we're doing is coming up with some sort of measure of undervaluation or overvaluation. So that's the whole idea with value investing. So you've got the market price, and you need to have some sort of proxy for what the market price really should be based upon fundamentals. And I think it's very clear that just using book value is completely unsatisfactory given what we know. And we know that intangibles have played an increasingly important role in the valuation of companies. So what we've done is something pretty basic in terms of, for example, capitalizing some research and development expenses. And think of it as the first step in a multi-step process to actually sharpen our measure of value that we use in terms of our investment management. So this is an important step. It is economically motivated, but there's certainly more work to do.
All right, Cam, so talk to me a little bit about the confidence that you have in this new definition of the IHML factor. And the reason I ask that is because we've written about this in the past, that oftentimes factors are discovered after having performed very well, and then they go through a period where the out-of-sample performance, falls flat, and as a result, you automatically think that maybe it's that definition that's been overfitted. How do you have confidence that this definition of the IHML factor is appropriate?
That's a great question. And let me answer it in two parts. Number one, the value factor itself has been around a long time. So indeed, as I mentioned, it was discovered basically 1930s. And it was made popular by the famous Fama and French article in 1992. So this factor has got a long track record and strong economic foundations. However, there's no one definition of value. There's no true measure of value. What we do know is book value is a completely unsatisfactory measure of value. So it ignores just too much of the value drivers that are so important for companies today. So most firms, like research affiliates, look at a number of different measures of value, but often book value is one of those. And what we want to avoid, and this is my second point, is something that I've called before factor hacking. And what that means is you've got a factor, and let's say it's the quality factor, but there are 40 different ways to represent quality. So there's a temptation to try to find the best way to represent it. And then it looks really good in the back test. You put it in production and it disappoints investors. So that's exactly your point about overfitting. If you overfit, then you maximize the chance that in the future, the performance will disappoint investors. Our approach in this paper is completely different. So we've got a value factor that's established. People use book to market routinely, but we look at the economic foundation first. So we don't look at the data. We don't try to do a back test overfit. We look at the fundamentals and notice that important drivers of value like research and development, patents, brands, customer relationship, it's all kind of obvious that that should be incorporated in value. And what we do is try to improve using these economic foundations, the factor, and then we look at the data, and we look at the data once. And when you do that, you maximize the chance that the performance will repeat going forward. And that's as much as you want, right? So you see a back test, it looks pretty good. And what you want is for that performance to repeat and not disappoint investors. Given this research approach, where we focus on the economics first, not the overfitting, that gives me confidence that this definition of the IHML will have robust performance in the future.
Okay, so let's assume that I'm an investor and I'm confident that this definition of the HML factor, or the IHML factor as we call it, is not factor hacked, as you say. Let's assume I want to move from a certain long only portfolio with a value tilt that has that value tilt generated by the standard HML factor, and I reposition it to have a value tilt positioned according to this IHML factor. What results would that have generically on portfolio positioning? In other words, would you have higher or lower weights to kind of high flying technology and popularity names, or to the fan megs that as people like to call them? How would portfolio positioning change as a result?
So basically, when you ignore all of these intangibles, you're misclassifying stocks. So some of the stocks that are classified as growth stocks, with this definition, they might be classified as value stocks. And that's really important. So essentially, using the traditional HML approach, the traditional book value approach, you're basically long the wrong stocks, and you're short the wrong stocks. So basically what's happening here, and it's especially important for some of these growth stocks, where you're ignoring all of the things that they've got, like software, that's completely ignored in the book value. So when you actually incorporate these reasonable metrics and have a different measure of value, then it mixes up which stocks are growth and which stocks are value. And when I say mixes it up, only compared to the past, because the definition that we're using has a strong economic foundation. So that's the difference, that you will notice that some of the stocks that you weren't invested in, or you were underweight, all of a sudden become overweight, and vice versa.
By the way, just a quick plug here. We have recently put out a publication that I think it's titled "Book Value is an Incomplete Measure of Company Size." It may be worth looking at that to see how the incorporation of this IHML factor changes the view of different securities based upon incorporating intangibles. So something worth taking a look at. All right, so Cam, we've talked a little bit about the fact that the HML factor is not necessarily the most robust kind of definition of intrinsic value for the value factor. I'm just curious, what about other factors? Are there other factors that are perhaps misdefined, or that perhaps don't capture kind of the premia that we're looking to exploit as investors as currently constituted?
Yeah, again, this is very challenging for a researcher and for an investor. So I mentioned already this idea of quality. So people generally think, well, quality is somehow got a risk premium associated with it. But how do we define that? So many different definitions, and you need to be very careful. So you need to be guided with economic foundations. This cannot be an exercise where you try all of the combinations of the inputs and all of the interactions between the combinations. If you do that, you're just going to overfit. So you need to have discipline in your research program to maximize the chance that you can actually, number one, identify a factor that's real, and then number two, actually be able to refine that factor. It is so tempting that you've got a standard factor that's been around for a while, and then you are tempted to tweak it. And you try a couple other variables, you get a better fit. But if those enhancements are not motivated by strong economic foundation, then I would say you're just basically overfitting. And when you tweak the factor, it's likely to perform worse in the future. So you need to have that strong discipline. And we've definitely got that discipline at Research Affiliates, where we lay out the foundation first, debate that foundation, whether it's reasonable. and only look at enhancements that are motivated by a strong economic foundation. If you go the other way, it might look good. And I'm afraid investors are often fooled by these backtests. Somebody says, well, we've got a better value factor. It looks great. It beats everybody. Well, it beats everybody likely because it's been overfit. They tried who knows how many different iterations to get that good backtest. So it's actually interesting that investors often looking at the backtest, you shouldn't choose the one that looks the best, because the one that looks the best has got the highest probability of being overfit. Choose the one that's got a strong economic foundation, and choose the one where you know the people that are doing the research have a strong research culture that basically maximizes the chance that when this goes live into production, that investors will not be disappointed.
Yeah, I'll just note, obviously, with the fundamental index, you've got multiple measures that you can use as a proxy for the economic footprint of a particular company. So it's not necessarily that you just want to choose the one, it's that you may want to choose, multiple definitions of any particular factor in determining how you want to tell your portfolio. Look, this is great stuff, and we're running a little bit low on time. I want to get to our next topic. Just for our audience members, just remember that if you've submitted a question and we haven't had a chance to get to it, or I haven't already asked Cam about it, feel free to submit it. Our team will reach out to you and make sure that all of your questions are answered as appropriate. But for now, let's just move on to the next research topic, and we'll ask questions from there.
Hi, I'm Campbell Harvey, and I'd like to talk about some provocative research that I've been conducting on relative value investing with Christian and Alex. So the idea is based on an academic paper that we published in SSRN, and that can be downloaded. And let me talk about the basic idea. So relative value investing usually involves identifying assets for purchase and assets for sale. So if we have 12 assets, we determine the 4 most attractive assets and buy them, and the 4 least attractive assets and sell them. So this is a standard implementation, and for a long-only portfolio, it would be the top 4 are assets that we overweight, and the bottom 4 are assets that we underweight. So it works both for long, short, and long-only investing. So our insight is really simple, that you can represent the standard long-short strategy by a series of pairs. And the diagram on the right tells the story. So the standard strategy can be represented by 4 pairs. Long asset 1, short asset 12. Long asset 2, short asset 11. And so on. And there's many different ways to do this. So what we're going to do is to actually build a relative value strategy from the bottom up. So going pair by pair. That's the basic idea of what we're doing. And what we're going to do is not just to look at the top 4 assets and the bottom 4 assets, but we will identify the most attractive pairs. And it's going to look different than the standard implementation. And let me tell you what I mean by pair. So a pair of just 2 assets. There'll be a signal that tells us what asset is long and one asset is short. So it might be gold and silver. Sometimes gold will be long, sometimes gold will be short. And this is really important. This is a method. It's independent of a signal. So you can apply this method to many different signals. And also, it is independent of time horizon. So you can apply this method to various different time horizons. So let's go through the details, and the details are very intuitive. What we will do is to decompose, and we do this by theory, the 3 drivers of the attractiveness of a pair. And the first driver is obvious. So we call the signal X and the return is going to be R, and that will be next period's return. So, for example, for asset 1, X1 at time t will predict R1 at time t plus 1. So the first ingredient is really basic, and that is that you need own asset predictability. So X1 needs to be able to forecast R1. And in our terminology, we call that B11. So we want that as high as possible. The other components are less obvious, but they're very important. So the second component is signal correlation. We actually want low signal correlation. So think of it this way. If X1 is high, then that will be predicting a high return for R1. But if there's a really high correlation between X1 and X2, that means the return on R2 is also going to be high. And if you're selling R2, then the spread between R1 and R2 is going to be really small. And the third component has to do with cross-asset predictability. So a high value of X1 predicts a high value of R1. But what if a high value of X1 also predicts a high value of R2? That's definitely not what we want. So again, the spread between R1 and R2 is going to be small. So we want that correlation to be really small. And we put it all together, we call it theta, and theta is just simply the attractiveness of the pair. And again, it's intuitive. The B11 and B22, the own asset predictabilities, those come in with positive coefficients, and the correlations between the signals and the cross-asset predictability come in with negatives. Okay, so this determines the attractiveness of the pair. What we're going to do is basically look at all of the possible pairs given a set of assets and pick the most attractive ones, and that's what we'll trade. So let's get to some results. So this first set of results, we need a signal, and the signal is going to be a simple one. It's going to be 12-month momentum. And the standard implementation we would call CSMOM, or cross-sectional momentum. So we've got 15 assets. They span stocks, bonds, commodities, real estate, very diverse set of assets that we'll look at. And the CSMOM, the standard procedure, you're going to be long 4 and short, or long 5 and short 5. And for the pairs, well, we'll look at the most attractive pairs and invest in those strategies. So let's zoom in on the results. So notice the difference in the average performance. The standard cross-sectional momentum, 1.9%, versus the pairs at 5.1. So the pair is much more significant. The Sharpe ratio is double the standard method. The maximum drawdown is less. The significance of the alpha is 3.16, which is much greater than the cross-sectional momentum. And another thing that I'd like you to look at is the turnover. So the turnover of the cross-sectional momentum strategy is 199% and substantially lower for the pairs-based strategy. So this is interesting, but it's just one signal. What if we look at another signal? And we picked a signal that's a much different signal, and this is a reversal signal. So again, we've got 15 assets. The standard procedure for cross-sectional investing is the CS-REV, where we've got 5 assets that'll be long, 5 assets that will be short, and we'll compare this to our pairs-based strategy. And again, you see a similar sort of situation. And again, let me zoom in on the results. The standard procedure delivers a 1.7% of return, whereas the pairs strategy delivers a 4.1% return, much more significant. Again, the Sharpe ratio more than doubles. Notice the skewness, so the downside risk to this. It goes from negative with the cross-sectional reversion strategy to a positive number. And we can see this with the maximum drawdown is less, the worst month is less. And importantly, in my opinion, look at the betas to US equity. The cross-sectional momentum strategy is a positive beta, yet the pair strategy is a negative beta, which means that it provides diversification for your portfolio. Also look at the significance of the alpha. The significance level is 3.95. And finally, what really jumps at me is the periods of stress, the global financial crisis, the COVID-19 crisis. Look at the difference between the pair strategy and the standard strategy. So the pairs delivers 9.9% in the global financial crisis, and recently has delivered 14.3% in the backtest. So very intriguing. But you're probably asking, well, what about the correlation between these two pair strategies? Can you put them together? And that's the last thing I'll show you. It turns out the correlation is surprisingly low. So we can actually get some diversification in terms of combining the strategies. So let me zoom in again. And what I'm showing you is the pairs momentum strategy, the pairs reversion strategy, and then a 50-50 mix of the two. And notice what happens. The significance goes up very substantially. The Sharpe ratio is superior to the individual pair strategies. So the 50-50 is much better than either of the individual strategies. We get positive skew, which is something that's very attractive to investors. We've got other properties that look attractive, like we retain the negative beta to US equities. The turnover is a reasonable turnover, and we do well in the two crisis periods. So this is meant as a teaser in terms of a larger research program that we're working on. So number one, let me conclude by saying that this research was motivated by theory. So we came up with an idea, we took it to the data, and the data is consistent with the basic theoretical framework. However, the framework is stylized. It's a simple framework, and we're working to generalize it. So for example, the way that we combine the three different return drivers is a very simple way, and we're thinking of enhancing that. We've got a research program to apply the pairs to many different signals. So I've showed you only two today. And finally, we want to establish a dynamic aspect of the strategy whereby the number of pairs that you trade in any given period depends upon the quality of the actual signal. So it might be in some periods you trade 4 pairs or 5 pairs, and some periods it might be only 2 that are attractive. So these are just 3 aspects of the research program. It's quite exciting, and I look forward to updating you.
All right, so that's another interesting topic. I've got a whole bunch of questions for you. And I guess my first one is that you mentioned that all of this research is based on theory. But can you walk us through, Cam, just the process for coming up with this framework in general? Like did you read different articles in order to come up with the idea to put this all together? Or did you just have kind of a bunch of different internal discussions from a research perspective where this kind of proverbial light just all of a sudden went on?
It's a very tough question, but let me try to sketch the process. So we were engaged in a process to develop an overlay. And an overlay usually works in terms of a long-short strategy. So some assets are identified to go long, some short. And in the context of a long-only strategy, that would be an overweight to certain assets and an underweight to other assets. So there's no shorting in a long-only strategy. So yes, you're right that you take a look at the literature and how do people set it up. And there's one thing that we noticed, and that is that essentially people do the same thing. And the way that Fama and French constructed their factors in 1992 basically has been carried on. carried on by academics and carried on by practitioners. And it's a simple idea that you sort your assets by the signal, and the assets with the highest value of the signal, you go long, and the assets with the lowest value, you go short. And that's the overweight and underweight. So that's the standard procedure. And one thing that we really like to do at research affiliates is to basically say, okay, well, that's a standard procedure. Everybody does it, but can we do something different? And let me give full credit here to my co-author, Christian Golding. And he basically came up with the idea of actually having a different approach, to actually looking at the components, to go, instead of just taking a group of assets with the highest signals and giving the same weight to all of them. Why not do it differentially, looking at the bottom up? And his insight was very important in this research program that develops a different way to do relative value investing.
Got it. So obviously, you tend to have a recurring theme here just about the research culture, and I know we'll get to that a little bit later. One of the things that I found impressive was just the results relative to just a standard cross-sectional approach for both the momentum and the reversal signals. I guess my question is, and you mentioned this can be applied to a whole host of different signals. So what's next? What are the other signals that you're looking to apply this kind of pairs trading framework to?
Yeah, so that's the beauty of this technique. It's not a signal, it's a technique for doing relative value investing. So what we did is to look at two very simple signals. So a 12-month momentum to start with, that's the easiest one. And then we looked at a reversal signal. But even within those categories, there's many other versions of this. So we've got another research project that looks at a momentum strategy with dynamic speed. So that means that sometimes you're slow, which might be a 12-month momentum. Sometimes you're fast, which might be a 1 or 3-month momentum. So that is also a candidate for this particular technique. But it's not limited to momentum or reversal. It could be anything. So there are hundreds of factors out there. We talked about value factor. We talked about quality factor. All of these can be recast in this pairs relative value framework. So we've got a long list of signals that we're going to look at and apply this framework to. And we've only done 2, and we are 2 for 2. Because you don't know what's going to happen. That's the thing. You don't know. You've got a benchmark of the standard model, the cross-sectional model, and you've got our new technique. And when we did the simple 12-month momentum, when we did reversals, our technique substantially dominated the standard approach.
Yeah. Yeah, and you mentioned in your in just the presentation of this particular research that this works in both a long-short format. It works with a long-only approach. It works regardless of the time horizon of, say, the momentum kind of signal. And I guess it's all applied to these, say, 12 or 15 different asset classes. But can you also apply this to kind of more granular exposures, like, say, individual countries or currencies or even individual securities?
Yes, and you're kind of guessing where we're going, and this is very important. This can be applied in many different settings. So one setting that's problematic to apply to is individual stocks. That the number of pairs is just too many. But if we're thinking, as you said, different countries, different industries, and there's many other groupings that we could actually consider, and this technique is perfectly suited for that. So this is definitely on our agenda. Indeed, this is a way you can even think about doing factor portfolios, where you've got portfolios of stocks that are sorted, and then each of those portfolios goes into this pair strategy. So there's many different possibilities here, and we're just at the tip of the iceberg.
Got it. Got it. So many of our audience is aware of this. We've got our asset allocation tool on our website that people can go to. They can see kind of long-term portfolios with expected returns and volatilities. Maybe fewer are aware that we already manage multi-asset strategies that are a little bit more tactical in nature, right? Strategies that take into account time series momentum and kind of where we are in the business cycle and different portfolio optimizations and overlay portfolios in order to generate more tactical positioning. I know you're somewhat familiar with a lot of these tactical processes that are built upon our own multi-asset strategies. And when you compare, say, this research to the existing kind of tactical processes that are embedded in those multi-asset strategies, do you see it as complementary?
Oh, definitely. So we've got a strong foundation in terms of what we already do. And what's really important is to always be doing research to improve what you've got. So we're fortunate we've got the foundation, but it's important to continuously improve. And you can view the research program that I've sketched today as an example of some improvements. And it's not the end, it's just the beginning. This is a continuous process that you need to continually be looking at different ways to sharpen what you're doing. And I think we've made a very good start.
Yeah, obviously. All right, so look, we've run out of time on questions pertaining to this particular topic. I want to get to the last few questions, some of which kind of rhyme with what a lot of our audience has already submitted when they registered. And the first one I have is more about kind of the number of research projects that are currently in the pipeline. And then if you don't mind just telling us, how did we come to that number? How large is that size? And then, is there anything that you feel comfortable enough sharing with us now that could be a preview to things that may be included in future webinars of this nature?
As research coordinator, I've got a dashboard of all of the active projects within research affiliates, and there are more than 40. So it's a huge number of projects. And part of my job is to prioritize projects. So, and basically what happens there is you look at the project and you look at the expected return on that project for the products that we offer our investors. So what I do is to try to focus on the ones that have the highest potential payoff. And that means that we're not operating on 40 things at the same time. It's a smaller number that we focus on. And I think that speed is important too. So it's better to get 5 projects into production in the short term than to get 0 into production because you're working on 40 different projects.
Yeah.
So that's important also. But there's a number of initiatives that are very important. Indeed, we have a second new approach to relative value investing that is not it's not published yet publicly, but we're actively working on it, and the results are very encouraging. And it mixes the idea of our momentum turning points paper and the pairs strategy together in a very interesting way. So that is forthcoming. And again, I can't share the document with the public yet, but it is very, very interesting.
Got it. Yeah, and for those in the audience, Momentum Turning Points is a paper that we haven't talked a lot about, but it may be worth another read. There's a couple of different papers there, one called Momentum Turning Points, the other one called Breaking Bad Trends, that I think is really helpful for those on the trend following side of things that are looking for a next generation approach there as well. So Cam, just out of curiosity though, you've talked about having an appropriate economic foundation before the creation of research or before you kind of dive right into a particular research project. I'd just be curious, you've joined Research Affiliates in 2017 as a partner and senior advisor. What type of a culture are you looking to instill, or have you noticed about research affiliates that maybe already existed when you joined that you're just trying to refine from here? What is our culture like on the research side? What do you want out of our team? How do you properly incentivize them? Questions like that, I think, are interesting to the audience.
Sure. The research culture is very important. It's what we do. So we need to do it really well. So there's many examples of toxic research cultures. And let me give you an example of a toxic culture. You've got two junior researchers, both high quality, good training, and both come up with independent ideas. And they approach the research coordinator with the ideas, and the coordinator says, go ahead, allocate your time to this, and you can work on like an in-sample sort of examination, and we'll hold out the out-of-sample. And they do their research, it's excellent, the in-sample looks really good, and we decide to take it to out-of-sample. And in the out-of-sample, the first researcher, the technique that they're proposing looks good, and the second researcher out-of-sample fails. Okay, so what do? Both of these researchers high quality. The ideas were high quality. The work was high quality. It turned out that one technique won and the other one lost. The worst possible thing you could do is to punish that second researcher, to cut their bonus because their technique didn't work. Research is really difficult, and most of the time it doesn't work. And what we really care about is to have the research discipline, and indeed to celebrate. If somebody did excellent work, they present it, and their idea doesn't work, well, that's fine. We learned something from that also. If you incentivize people just to produce stuff that works, in quotations, then you set up a data mining research operation where people will data mine to try to get the result that works. And indeed, that's the last thing you want, because when you take that into live trading, you're surely going to disappoint. So the culture is celebrating high quality work. Curiosity is really important. Economic foundations, fundamental. And I think that there is something else here. And there's a lot of good ideas out there, and a lot of interesting projects. But what I've tried to do is to really focus the attention on those projects that will have an immediate benefit to our products. Okay, so I think that's really important in my calculus in terms of how to give priority to different projects.
Got it. Yeah, and just as a note, both of these pieces of research that we've covered today are either in or being incorporated into our existing strategies at the behest of the PMs. So certainly glad to see that results, of this research can ultimately benefit the end investor. All right, Cam, this has been a really helpful discussion for me. I feel like I could be here with you all day just asking you questions about all this different research and what you've got in the pipeline. It solidifies in my mind that we probably need to do this again moving forward, which, hopefully you're okay with, correct?
I'm definitely okay with that. And I look forward to additional questions, both in this format or emailing me directly.
Great. Just again, for our audience, if you have questions that you've submitted, we'll be sure to reach back out to you and make sure that we answer those questions. Also, as Cam alluded to, feel free to reach out to us directly. You've got our contact information. We can fill out or we can make sure you get answers to your questions. And then lastly, feedback is a gift. And if you don't mind just filling out a survey at the end of this webinar, that'll help us improve for the future. Thanks again for joining, and we hope to see you again soon.